Okay, let us do the same thing, the same example, the same set of transactions. Let us apply the traditional approach and see whether we draw the same conclusion. Whether we draw the same conclusion. We have to do the same. Approach is the same. First, we have a transaction. Identify the accounts involved. Then, what is the account? Is it real? Is it personal? Is it nominal? Once you know the nature of the account, apply the golden rules. Apply the golden rules. Okay, let us try. Capital introduced 5 lakhs. So, first, what are the accounts involved? So, we got the transaction. Accounts involved are cash and owner. What is the nature of cash? Is it personal? Is it real? Is it nominal? Cash is a real account. It's an asset. Cash is a real account. What is the rule for real accounts? Debit what comes in, credit what goes out. Cash has come in, therefore debit what comes in, we debit cash. We debit cash. Next we have owner's account, owner account, or it's actually capital account. That is a personal account, right? Personal account. What is the rule for personal account? Debit the receiver, credit the giver. Credit the giver. So the owner credit the giver has given money, credit his account or credit capital. So what is the entry? Cash debit, capital credit. Cash debit, capital credit. It was the same thing as per our previous approach. Accounting equation approach. Deposited into bank 4 lakhs. Accounts involved are cash and bank. What is cash? We said it's a real account. In this case, we have put cash into the bank. So as far as the business is concerned, cash has gone out. Cash has gone out. Debit what comes in, credit what goes out. Credit what goes out. Cash has gone out. Therefore, credit cash. Credit cash. What happens to bank? Bank is an artificial person. We have given, it's a personal account. We have given money to the bank. What does it say? Personal accounts. Debit the receiver, credit the giver. Debit the receiver, credit the giver. So debit the receiver, debit bank. Debit bank, credit cash. Same conclusion. Bought furniture, issued check. Bought furniture, issued check. What are the accounts involved? Furniture, bank. Furniture, bank. What is furniture? Furniture is a real account. Debit what comes in. Real account. Debit what comes in. Debit. Debit furniture. Debit furniture. This is changed. Okay. What about bank? Bank is a personal account. Bank is a personal account. In case of a personal account, what is the rule? Debit the receiver, credit the giver. Debit the receiver, credit the giver. Now what has happened? The bank has given money, right? Debit the receiver, credit the giver. The bank has given money, therefore we credit bank account. Next, bought goods, issued check. Goods and issued check. What are the accounts involved? We won't have goods account. Remember, if you've purchased goods, bought goods, we call it purchases account. And issued check, so bank account. Purchases is a nominal account. Debit all expenses, it's an expense. Debit expense, therefore debit, not goods, we'll call it purchases. Debit purchases. Credit bank. Bought goods on credit from Azad. Bought goods on credit from Azad. So what are the accounts involved? Bought goods on credit from Azad. Purchases, goods, we are not opening goods account. Goods purchase, we are opening purchases account and Azad's account. What is purchases? Purchases is a nominal account. Purchases is a nominal account. Debit all expenses. Purchase is an expense. Debit all expenses. Therefore, debit, we won't say goods, we will say purchases. Debit purchases account. What about Azad? Azad is a personal account. What is the rule for personal account? Debit the receiver, credit the giver. Azad is given as goods. Debit the receiver, credit the giver. Credit the giver. So credit Azad's account. Paid rent. Paid rent, 20,000. Rent is what? Rent is an expense. Please remember, rent is being paid to landlord. We don't say landlord account to cash. Rent is an expense. Why don't we say landlord account debit? If we say landlord account debit, it indicates that this money has to be collected from the landlord. Rent is an expense. We are paying the landlord for services he has already given us for the use of his premises. So what are the accounts here? It is rent and cash. What is rent? Rent is a nominal account. It's an expense account. Debit all expenses, therefore debit rent. Cash is a real account. Cash is an asset. It's a real account. What has happened to cash? Cash has gone out. What is the rule for real? Debit what comes in, credit what goes out. Credit what goes out, therefore credit cash. Sold all goods, received 4.2. Sold goods, goods go out, but we don't say sold goods, we say it is sales. So what are the accounts involved? Received a check. So bank account and sales. Bank account and sales account. What is bank? Bank is a personal account. Personal account, what is the rule? Debit the receiver, credit the giver. So bank has received money. Debit the receiver, debit bank. Debit the receiver, debit bank. What about sales? Sales is a nominal account, is an income account. Debit all expenses, credit all incomes. Credit, no, we won't say goods. We will say sales account. We will say sales account. So we've actually drawn the same conclusion whether you follow the traditional approach or the accounting equation approach. Identify the transaction. Identify the accounts involved. What is the nature of the account? If you are following the traditional approach, find out whether it's real, personal, real or nominal. If you're following the accounting equation approach, think whether it's asset, it's liability, it's income or it is expense. Then apply the rules. What were the rules for what were the rules for a traditional approach? Traditional approach for personal accounts, debit the receiver, credit the giver. For real accounts, debit what comes in, credit what goes out. For nominal accounts, debit all expenses and losses, credit all incomes and gains. In case of the accounting equation approach, increase in asset, you debit. Increase in expense, you debit. Decrease in expense, decrease in asset, credit. Increase in liability, you credit. Increase in income, you credit. Decrease in income, decrease in liability is a debit.